As widely expected, the Bank of Canada lowered its key rate a quarter point to 2.25%. Joining me now to discuss the latest decision is Francis Fong, senior economist with TD Bank Group. And Francis, what's your reaction to the decision? Any surprises here?
Yeah, first of all, thanks for having me back, Anthony. Always great to be here. So no surprises in this decision. I think this was a widely expected rate cut. If we look at sort of where the growth picture has come in, where the inflation data has come in, where the unemployment rate or the employment data has come in, a lot of it has pointed to additional space for the bank to sort of lower rates and support that overall economy. We've seen quite a lot of weakness in areas like exports, investment, whereas we've seen maybe a bit of resilience on the consumer spending side, but enough so that the bank could kind of provide that additional cut. No surprises there.
Now, the big question is, does this latest cut mark the end of the Bank of Canada's easing cycle?
Yeah, and I think this sort of follows where the sort of economic profile is going to be in the next few quarters. We do anticipate that second quarter growth, which was quite weak in a lot of key areas, we do expect that to sort of be the bottom in growth. We're already seeing the kind of Q3 growth picture sort of come back a little bit, though perhaps not as strong as some would like. And so that should provide some basis for the Bank of Canada to remain on hold. I mean, at 2.25, we're already talking about where the Bank of Canada sort of finds the neutral rate. And so I believe the bank is quite comfortable where they are. And they actually did communicate that so long as the economy progresses how they envision it, and so far the data is sort of lining up with that, this is likely where they're going to keep the floor. So they've already choreographed that well. So absent any kind of surprise on the downside, or in fact the upside, this is likely where we're going to see rates for sort of the medium term.
I think one area that there's a lot of uncertainty right now remains tariffs and the lack of a deal between the U.S. and Canada. Now, big question, what happens if we don't reach a deal, and what are the implications for monetary policy?
It's a great question, Anthony. And I think this is obviously where there's quite a lot of uncertainty, because if you read the headlines and you read the headlines alone, it will give you the impression that things are in a very dire state. Obviously, we just sort of had a potential trade deal fall through, according to Prime Minister Carney. And so that kind of leaves a lot of folks with a lot of uncertainty. I think if you dig into the Bank of Canada's monetary policy report, and even in our own forecast, we do embed an actual tariff assumption in those forecasts. Bank of Canada, for example, has an average tariff rate of about 6% as of their October monetary policy report. That is a far cry from the big double-digit numbers that, for example, Trump is talking about and things of that nature. That's the actual one that we see. But on the same token, that is not felt evenly across the country. That 6% is really a reflection of the much higher tariff rate we're seeing on steel and aluminum, on non-CUSMA compliant autos, softwood lumber, things of that nature. So we do see some higher sectoral impacts, whereas the actual average tariff rate is quite modest. So what that means is there's still going to be uncertainty going forward, because that 6% tariff rate is being felt in some parts of the economy. So we're still hoping for that deal to sort of remove that sort of uncertainty. But if no trade deal takes place, we're sort of where we are today, which is sort of a major headwind, but we're still seeing some resilience behind the scenes in areas that are not so hard hit.
All right, now we also have the upcoming federal budget soon. What are your thoughts on that, and what implications, if any, will that have on Bank of Canada policy going forward?
So I mentioned the neutral rate a little bit earlier. I think that's really where we're going to see the impact of where the Bank of Canada thinks the Canadian economy is going to be long term, because all the conversations around the federal budget, everything that Mark Carney is talking about right now is around how do we sort of reorient the Canadian economy away from a trading partner, a primary trading partner that is perhaps less reliable than it has been in the past. So how do we create those new trade routes in between the country, or sort of within the country, and of course across the Pacific and across the Atlantic? That requires huge investments in everything from trade infrastructure, transportation infrastructure, making our firms more competitive in those markets that previously we haven't really had to compete in up until now. So what does that picture look like? So where we're looking for more clarity and more guidance is, what are those investments that we're going to make? Obviously, we're already hearing things about major projects and things of that nature. But beyond that, how are we establishing ourselves in those markets, and will it work? And of course, that has sort of implications for what the trend rate of the overnight rate will look like. And so there's implications there. But in the short term, it's likely not going to have too much of an impact.
All right. So given this latest decision, how do you expect the loonie to perform going forward?
So I think the narrative around the loonie has been difficult to parse. Up to, or sort of over the last year, we've really seen the Canadian dollar be part of this broader narrative around US dollar weakness across many of its trading partners. And that's sort of driven a lot of the dynamics over the last year or so. Lately, I think we've seen more divergence among advanced economies relative to the US dollar, where it's like short rate differentials. So given that the Canadian economy has performed, I think, relatively weaker than a lot of our advanced counterparts, and that's obviously especially true given our reliance on the U.S. There's been, some more pronounced weakness relative to some others, but we do anticipate that as the sort of economic profile improves over time and we start to see that growth picture sort of get a little better, we're already seeing, some upside surprises on the employment side, on the inflation side. All of that, I think, will contribute to some some Canadian dollar strengthening, and we do anticipate it to strengthen from here to about 75 cents, sort of towards sort of late next year and through our medium-term forecast horizon.
Now you talked about inflation, you talked about jobs. Are there any things, key reports that you'll be watching closely to get a sense of how the Canadian economy will perform over the longer term?
I mean, that's a complicated question. There's a lot of data we're looking at. Obviously, growth, inflation, and employment, the obvious ones that we'll be keeping an eye on, because there's been quite a bit of volatility, driven no doubt by the uncertainty that firms and individuals are facing. But on top of that, we're really going to be looking at the political side. What's coming out of this budget? How does that set us up long term? And we're going to be looking at a lot of individual components of GDP. For example, how does the trade picture improve? We saw a massive decline in real exports, particular, 32% annualized reduction in real goods exports. How does that trade picture improve? All of that, I think, contributes to how is the Canadian economy staying resilient in the face of this new threat, and how do we sort of evolve going forward? So lots of data that we're keeping an eye on.
Francis, thanks for your time.
Always a pleasure, Anthony.